Good afternoon, everyone. So this is a nicer picture. Today we're gonna talk about real estate, obviously, and I think some of you already know me and the fund, but we're gonna spend the next 30-ish minutes here talking about the big question marks in the real estate market, and of course go through some of the updates on the fund. And please send in questions if you might have any. We address them at the end of the session. So a little bit from a top-down perspective, then go over to the fund and then the questions. You already know about the fund. Sorry, we have delivered about 8% annual return since inception. This is net of fees. We have currently 36 holdings. This is a little bit more than usual. You know that we typically run with a concentrated portfolio, but with keeping the diversification effect intact. So it's typically between 30 and 35 holdings, and we do some reshuffling at the moment. Therefore, it's 36. Moving over to where we are today, but we start with last year, and this is no news for most of you, but we saw this big hammering on real estate last year due to the pandemic. We actually lost about 25% versus the broad index, global all sector index that my colleagues are comparing against. And we saw this big dispersion among the sectors with the data center and industrial coming out as winners and the more service or face time sectors coming out as losers, retail, hotels and office. Interestingly enough, if you look at the cycle and the downturns, this is a graph over the real estate cycles we have seen in US over the last decades. If you look at the black line here, this is the pandemic, came down very quickly, but also recouped very quickly. And on the X line here, you see, or X axis, you see the number of months before the recovery. So this was a rather quick one. And it has to do, of course, with reopening of the economies, stimulus, and also the, all the stimulus, both from the central banks, the governments, and in US, for instance, the cash stimulus that we saw to the population that they could go shop for, etc. So this was a fast recovery. But despite this, if we consider the downturn started in February last year, which everybody basically do, we haven't seen recovery in the real estate sector as a whole on a global basis. There are big differences, but this is on a global basis, right? And it compares to the global all sector index here. So there's still a huge upside for the real estate recovery to happen here. But of course, big discrepancies in geographies and also in subsegments, of course. If we look at the big real estate markets, you have seen this picture before and it's interesting to follow. This is year-to-date numbers, starting with the US on the top. They are in the lead. We have seen this correction coming through the last couple of weeks and it has start to rebound. These numbers are from earlier this week, 23% in US terms, and SKAGEN A-EUR as a fund performed about 14% in US dollar terms, as did the benchmark or the real estate benchmark, the global, but also the other all sector benchmark. All three are on 14% as of Monday, Tuesday, I think I did this. But US real estate are still lagging, and it has to do with a lot of Delta virus discussions, reopenings, etc. And worst outcome of all has Asia Pacific region here, and it by the obvious reason of what's happening with Evergrande, Delta virus popping up in Hong Kong, for instance, and growth prospects for China, etc. But with this said, and the ones of you that follows the fund knows that I'm has been underweighted in the US, but we're still keeping up the market, which is very, very good, especially since we are invested in Asia as well. This is a global fund, and we should due to interesting names, valuation, and diversification, be invested around the world. That's what you're actually buying into. But then obviously we reshuffle markets and segments as we go. Please look at the right side of this. Has nothing to do with geographies, rather the outcome this year on subsectors. If you remember the first slide, industrial came out very well during the pandemic year. It has also come out so far this year as a winner, but also residential. Here it's both developers, but also rental residential companies, which is a big difference, but still it's a residential subsegment. Retail has performed well as of 7th September. And the main reason for this is these subsidies that we have seen to the US population, where they actually went to the shopping malls and started to shop. That was withdrawn in mid-August, I think, this subsidy. So it will be very interesting to follow the retail sector as we go along, more normalized, so to speak. What hasn't been performing that well is office, diversified, and hotel. And obviously diversified has a lot of office within, but also residential, also some industrial and things like that. And this is where I have put a lot of focus this year. We have talked about office before. I have been a believer in the existence of office going forward as well. And I see anecdotal and hear anecdotal evidence of that every day now. People are more or less forced back to the office. In the US, they can force you, otherwise you have to find another job. We don't do that here. But your employer tells you that we love to see you at the office, but you can do it with some freedom and flexibility. So this is the trend at the moment now. And interestingly enough, we have spoken about that as well, the ones that were most vocal in the beginning of the pandemic was the tech companies, right? The Amazons, the Googles and things like that, and said everybody's going to work home, they're going to move to the countryside, and we don't need any office. But the biggest uptakers in New York and Manhattan this year has been the tech companies. The last example we saw 2 weeks ago with Google buying an office for $2.1 billion US. It's one of the largest transactions ever made. So they were really clever because they said this and it put pressures on rent, put pressures on occupancy and everything. And then they went in to negotiate these new rental deals and buying and new rental deals, which is interesting. And they do it under the reason for it, they say, is that they want to build a culture and they want people to socialize and be creative and things like that. So we're a little bit back to where we started, and the human needs to put it that way. We're not there yet at the office side, but the trend is really going that direction. And it has a lot to do with economic development, as you know. Since before we have talked about the correlation between GDP and the commercial real estate development. There is also a lot of question marks still about the hotel side. We have seen the leisure side of hotel continue to prosper, but the business side of it, people traveling for business, is still struggling, especially in Europe. It's a little bit better in the US, but things will probably evolve even on that side when things are more normalized. If we look at the valuation, you might remember this graph from earlier this spring. Then it was more of a buy if you look at the valuation than it is today. A year ago, it was a screaming buy, and this is net asset value or the substance. So, and this is an aggregated picture, which doesn't tell you which segments we're talking about or which geographies. This is global aggregated picture from 31st of August. So the conclusion of this graph, it's nor very cheap nor very expensive. It's a tad above historical mean here from the beginning of 90s. So if we decompose this a little bit, we can see on the left side, the regions and the valuation on the substance in relation to return on equity or the return of the companies. If we forget about the small countries on top, Belgium, Israel, and Czech Republic, because they're a little bit of outliers since there are not that many observations or companies within them. We can clearly see US is trading at a premium, but this is weighted average, and it has a decent return on equity still. But there are other countries or geographies like Japan, Germany, for instance, that are much cheaper, but also has the same return on equity as spot views or as we speak. If we move over to the right side, we can clearly see industrial coming out as the more expensive sectors, underbuilt by strong growth and a strong tailwind from e-commerce, supply chain issues, domesticization of production, etc. So there are a lot of forces behind the industrial sector as of today. On the other side, we see hotels again, office is struggling, and diversified since they're typically traded with a conglomerate rebate or discount. Residential side is still providing good returns, but they are also trading at a cheap level. German residential is one good example here. So this is a little bit of decomposed oversight currently of the sectors and geographies. We have earlier talked about this correlation, if you want, between commercial sector and the economical development. This is a graph showing the G7 countries, so it's global, but not including all the countries. Here you can see clearly what I mean, that the GDP development is more important in my world than the rent or interest rate development. When the pandemic hit the stock market, the GDP went down in the cellar very rapidly, but also came up very quickly. And the profits were coming along, but it has a lag within it, of course. So the gray and the green dots there are consensus estimates. Where do we go from here? And it has been confirmed from the first and second quarter numbers, profits are increasing, not only in real estate, obviously, but in real estate. And if consensus are right, they will continue to increase, but it's multiples of components that will depend on that. But I think personally, Q3 and Q4 numbers will come in pretty good, as well as people returning to work, as we start to consume, etc. And not only products, but also services and things like that. So it looks pretty bright. And a lot of the companies that I hold have grown into the valuation, not fully, because some of the companies are valued at a lot of growth in the future coming years, but they still grow into it step by step, which is as a positive sign, of course. We have talked about inflation before, but I will touch upon it again since it has been revitalized now the last couple of weeks. It was very hot topic earlier this spring. I want to show you how real estate has been reacting over a long time of period in different inflation scenarios. This is not something that will show how it will be in the future, but you can find some support in the history anyway. On the left side, you have the gray bars. They show high inflation. High inflation is defined as plus 6.9% inflation. The green bars are moderate inflation, it's 2.5 to 6.9, and the white bars are low inflation, below 2.5%, basically what we have been experiencing the last decade. On the right side, we have two different graphs. One is US listed real estate, the other one is S&P 500, so all other sectors. The dark blue is the capital value increase or decrease, and the light blue are the dividends. So this is the total return concept of real estate, for instance. In low inflation that we have been experienced, this real estate has not been as successful as other sectors. In moderate inflation, 2.5 to 6.9, real estate stand out as a winner during this period, 1972 and to 2020. And in high inflation, real estate is a tad above, but basically everything is about the dividend payment here. So why is it like this? We have talked about it before, but one very good explanation, of course, is the leasing adjustments that we have in the contracts basically all over the world. Not that much in the emerging markets, but still in this part of the world, in the US. So I have different methods to step up the leasing contracts and adjust it for inflation. Second component that is also very important, I would say, is that when prices are increasing on labor, input costs, cement, building construction, everything, big projects are put on hold or they are actually scrapped, because, and especially the more speculative projects, what happens then is that supply is vanishing from the market, and the ones that has the assets up and running and operating, they will sooner or later experience some higher occupancy, and they can start to take out higher rents, because inflation is typically also a signal that the economy is very, very strong, right? There is other components like for hotel self-storage, etc., that they can rise prices more in real time than companies that has 5-10 years leasing contracts. So they can actually be more proactive on the price increases. And also, fourth component that I'm not putting that much emphasis on it, but if you have big debts, which typically real estate companies has, and you have them fixed, inflation can erode the debt pile a bit. But on the other hand, it's offset by the higher interest rate cost that typically comes from inflation, right? So that's not the main topic here. But inflation is not something we fear, rather the opposite. It has been very beneficial for real assets in inflationary times. And we talked about the interest rate, and that we can discuss for the next hour. But typically, what I tend to say, if it's not too much and too unexpected, it's not a very big deal. Especially now, after so many years of low interest rates, the companies have refinanced themselves on long-term periods and at very low levels. So. But of course, if you have a very extreme interest rate hike, it will hurt all the stock market and all the assets basically instantly. So I don't think one should be too afraid of that. It seems to be under control going forward, and one can ask the question if the big economies like US, if they can afford to increase the interest rate too much. As they have a huge debt pile themselves to absorb. We have talked about this before. I just want to remind everyone that we are in a transition on the real estate market, a transition that I think will keep on going. And has nothing to do basically, or very little to do with the pandemic, even though the pandemic has accelerated this development. But we have seen industrial over the 10 years in US, for instance, come from 4% market weighted to 11%. We have seen completely new segment. It's data center and infrastructure. And we have seen retail is declining. These numbers are from year end, so I think retail has come up a little bit since it has been a good performer this year. But the trend is undoubtful. This that we see on the graphs here, that we will see big changes in the composition of real estate, and it's perfectly natural as well, since the economy is changing and the way we consume real estate is just changing. But this is long-term trends, right? And this is basically the same thing, but what I want to highlight here is the light blue bubbles, because this is the global composition, and the global composition is always lagging the US composition, has been that historically anyway. So if you look at US, they have 43% of the so-called traditional sector, office, retail, etc. But the global scene only has 67% of the traditional real estate. And on the other hand, global has just 1/3 of the alternative sectors. So the thesis here is that the global scene will increase their share of alternative real estate sector. Maybe not in line with US, but still it will narrow that gap. And this provides opportunities, and we see that all the time, especially in Asia, that are after Europe in many ways. So it's an interesting development that is worth keeping an eye on, and also explains some of our weightings and holdings and why we do things. Let's move over to the fund. This is the numbers from beginning of the week. We keep up with market, as I said. It's extremely volatile at the moment, so it's changing by the day in the relative terms. We are ahead of our benchmark on all other metrics beyond a year. And I want to emphasize another time that this should be viewed over long term, since we are operating in a stock market and we are not immune on corrections nor bull markets. So it could be volatile times, as you know. So anyway, we are working for improving the numbers. 8% is the number that that you have received net of fees if you became a shareholder day one of the fund, soon 10 years ago. Oh, last time we met, we did some things here in the light figures, or yeah, in the light color. And the other ones that we have, the new things that we have done is more visible here. So let's start on the left side very briefly. We have entered a small position in Great Portland. That is an office operator in UK, mainly in London. The London office market, but certainly the retail market has been punished from the Brexit and the pandemic. We have seen values declining quite heavily, especially in retail. This has reversed and things starts now to look more bright. People are getting back to work, and we see good signs of a positive development here. Paramount Group is the same. It's an office operator. They are only present in Manhattan and New York. It's a smaller peer than the previous holding that we have had, SL Green. Paramount is lagging the peers and is trading very, very cheap. And this has to do, of course, with that Manhattan was really hammered during the pandemic. Nobody actually went to work, and it was lockdowns and everything. Paramount has been subject to a takeout 2 years ago, but it didn't succeed. And I think it's a good chance that some will take this company out eventually. One takeout that we actually had recently, or it's pending, it's Columbia Property Trust, and 1/3 of their portfolio was New York and Manhattan based, and it was also a very cheap peer to Paramount Group. Both this company has to have the tailwind from office recovery, people coming back without any new Delta viruses or whatever name there are. So this is a slow transition versus going to work. Tokyo Furusan is also an office operator, but they also hold some hotels, both on the business side, but mainly on the leisure side. But what they also own, which is the most interesting part, I think, is a renewable energy business arm, which in this case is solar. And they have a huge pipeline in this case, even though they already operate these renewable energy plants, solar parks. And this company has a huge conglomerate rebate, but they can actually sell off both every asset that they have and crystallize value. But my take is that they will sooner or later start to sell out these solar plants to REITs, which is more about maintenance and some dividend payments for big institutions. And they crystallize the value of this and put the money in new interesting renewable energy projects. We move over to German residential giant Vonovia. We switched into that when they announced the merger with Deutsche Wohnen. Vonovia has also rental apartments in Sweden. They bought another previous holding, SKAGEN A-EUR, but they also hold apartments in Netherlands. So it's diversified and it's big, and rental apartments is all about economies of scale. So I'm totally for the merger with Deutsche Wohnen, but it has been a segment and geography surrounded by political uncertainty. We remember the rental freeze. We know about now the nationalization claims, the German election that passed last Sunday, etc. So they are a laggard this year, but there are still good upside in these names on a risk-reward basis. Another new holding, also an office operator, is ICAD. And the main reason why I bought into that was that they hold 58% in a healthcare company, ICAD Santé. And this is a sector that interests me a lot, both because it's very unconsolidated or fragmented in Europe, but it's driven by an aging population over the next 30 years in Europe. So we have to have good real estate to take care of the elderly people. Some days after I bought into this, they announced the IPO of the healthcare part, and it will be effectuated tomorrow or on Monday, I think. And this will eventually crystallize some of the value or the discount that we have seen in this company. And ICAD is a typical office operator present in France in major cities. So that also has some communicating or some bearing on the office recovery that I hope that we will see continuing. Marcus Corp is an odd bird in the portfolio. It's not a pure real estate company. It's a US entertaining, it's actually the 4th largest cinema company in the US, but basically all the value is made up by real estate. And it has been hammered during the pandemic, both the hotel parts, but also the cinemas that they own. And they also own other things like golf courts, etc. But the interesting thing is it's very cheap and it has a lot of interesting real estate. So one risk here is obviously streaming, but Disney 2 weeks ago announced that they will also release all the new releases, both physically in cinemas, but also on the streaming platforms. So this is a way back, and I think somebody compared the streaming threat with well, there are a lot of houses with kitchens in the world, but people still want to go out to a restaurant. And that's a little bit thoughtful, I think, because you want to experience something. So I'm not that afraid of the cinema part. That comes on as a bonus on the purchase here. It's a small position, but very, very interesting. We have sold out Adapteo. It was taken out by Goldman Sachs Infrastructure Fund earlier this spring. Deutsche Wohnen we talked about. Cellnex sold out with a good profit, almost 50%. Not that long ago. Cellnex is the Spanish and pan-European tower company. Iguatemi is shopping mall. It's a pure shopping mall operator that we bought into in the spring. Took some profit, not as much as I'd hoped for, but things were getting a little bit more nasty in Brazil with new Delta virus and plunging reais or currency, etc. So we took that money and recycled into the left side on this picture. You have seen this picture before. It's the balance board here between the recovery part, bit more risky since the jury is not out on the office side. How much will we go to the office? Hotels, how much will we travel, etc. But they are typically the more cheaper companies in the portfolio and the more stable, more economically resilient companies on the right side, a bit more expensive. But we have self-storage, rental apartments, healthcare that are not totally resilient of economic development, but they are rather resilient, I would say. So this is it's a very good backbone to have in the portfolio, and it's about 40-60% share between them. You have seen this picture before. It's what I want to show you about our philosophy outside the real estate metrics or real estate fundamentals. These are the things that are happening outside. It's hard to predict, but there are more or less probability of it. Capital management initiatives, for instance, something we like. Share buybacks, if you're trading at a big discount, you're buying back your own assets at a huge discount. Maybe you're selling some at a premium to book value, which is very accretive. Here is 2 examples. Activism, we have talked about a little bit. Activists come in, make things better for the shareholders, and that's also our claim to be on the earth, to make good decisions for our shareholders. M&A, we have had 5 big situations this year. 4 has been our company's been taking out or is pending actually, and 1 is ESR. They are actually purchasing another company where they actually double their assets base overnight. So this is going to be the largest Pan-Asian logistic operator after this, if it's coming through this proposed acquisition. Then we have the restructuring part. 2 very successful this year. Unfortunately, CA or Hong Kong Asset Holding is listed in Hong Kong, and it has been a shot by association with this Evergrande and all the question marks over there. But CapitaLand listed in Singapore. What they actually did was they totally restructured the company. They sold off the development part, the high-risk part. They gave us shareholders a small piece in a shopping mall company, a pile of cash, and a stock in CapitaLand Investment Management. And this investment management company will be more of an asset-light vehicle, like a Blackstone, like a Brookfield, or this big investment management holding companies. It has been very profitable so far, and the big difference between CapitaLand and the US peers are the valuation. CapitaLand is still much more cheaper than those, but they're doing basically the same thing, but they are focusing and heavy in Asia. So portfolio on the left side, Columbia Property Trust was taken out recently, so we came down from 30 to now 25% in the US, still a heavy underweight, and I tried to show you the explanation of that is the valuation part, and I found also interesting companies elsewhere. So it's still a very active portfolio. We are front loaded on industrial property and residential rental. We are still very cautious with retail. I hear myself repeating this every time, but you have some I'm constant in what I'm saying anyway. I wanted to show you on the right side below the risk return profile the last 10 years, and this is standard deviation. What we have seen then is industrial has performed best, but has also provided among the lower risks. So here we have been very good positioned. Hotels on the other side, not that good return and very high risk if you say that risk are standard deviation. Retail the same. I don't think this picture will change dramatically. It might change over time, but I think in that case office will move a little bit higher. But also maybe on the risk scale if the supply is increasing too much. 10 largest position, it's all familiar names within this that we defined as the defensive growth. It's 42% of portfolio. Names are familiar here. There are a little bit of reshuffling. Catena, for instance, in the middle now instead of among the top names, has taken down that position a little bit due to good profit and to balance it a bit. What has worked and what has not so far? On the left side, we have talked about Adapteo on the takeout. You can also see 2 logistic names, Prologis and CTP. We have 1 data center, it's Switch, and this is interesting because they announced they are considering to converting to REIT, and that's important in US because then suddenly a lot of investors can enter the name as they can only invest in REITs, because today as they are growing, it's much more profitable for them to be a non-REIT, because then when you are in a build-up phase, it's better to not handing out all the money to your shareholders. It's better to use them in the company. But also Elliott came in as a shareholder, which typically is a positive thing to speed things up. On the negative side, we've talked about Kenshin before. It was the activists that tried to take out the company but did not succeed, and they wanted to come out, and it takes some time, so it has been suffering a bit due to this. We still like the company. It's still very cheap. We have still made double since we started to buy into it. The stock is still trading at a double price, so we still have a good profit on it. And I think eventually things will change in that company. But it's the worst performer this year in terms of contribution to absolute return. On an aggregate picture, what have we done right? What have we done wrong? We have definitely done some really good stock picking here, and it has been saving us this year due to our poorer allocation, meaning that we haven't been more heavy weighted in the US. So allocation part is negative, stock picking is really positive, and a tad negative on the interest rate, the currency, but that's not something we speculate in. So you still get a much cheaper portfolio, both on cash flow metrics and book metrics. We have about the same debt levels as the benchmark. We have a lower dividend yield, and you know why. We have talked about it a lot. We prefer companies that are reinvesting the money on good projects. Therefore, we get the earnings yield that are basically the double versus what the benchmark shows today. So to sum this up, you have seen this picture before. I think it's good because that's where we are. We are not that much down in the basement anymore. We're actually having the nose above the ceiling now. But still, if we try to sum up where we are, we still see the recovery and the stimulus are driving the fundamentals. We saw good Q1, we saw even better Q2 numbers. I'm sure we will see even better Q3 and Q4 numbers as they are published soon. All three drivers that we are keeping very, very close eyes to, supply, demand, and credit, are in balance. There are exceptions. China, for instance, Evergrande, it's a company levels, but this is no news for us. But they are moving in the right direction. And once again, most companies are refinanced at very low levels at long time. So I'm not that worried about credit. And the reason for the fast recovery that we saw this correction was that there were no credit crisis whatsoever, because the market was flooded with liquidity. We have a very dispersed valuation situation with some companies that are expensive, some are very cheap. As that the same can be said with the geographies. For instance, Hong Kong names, some Japanese names are very, very cheap today. Some US names are very, very expensive. So one has to look out there. We are still in this early expansion phase that we discussed last time, and it has been the best, historically the best period for real estate, where you have low interest rate, stimulus in the economy, not only real estate, of course, but we are moving slowly out of this expansion phase into a more mature phase in the cycle. This is not a bad phase, but it's not as profitable as we have seen last year, for instance. Typically, it's the more mature phase sees increase in interest rates, and but still, as long as you have a strong economy and building this up, it's very profitable for real estate as well, especially if you have this inflation and we have this inflation parameters that we have talked about earlier. And I think subsegments will continue to act as they did before. Some has leapfrogged, for instance, warehousing due to increase in e-commerce, but the pre-pandemic trends will continue a little bit different pace. And there is a lot of money committed to the asset class still, both to real estate, but also increasingly in infrastructure. And as you know, there is a very close alignment of with real estate and infrastructure. There are risks. We have talked about them. We can talk about them later on as well if you have any question. My last picture. This is listed real estate on a global basis the last 21 years. It's the red boxes. The cream or slightly pink boxes are physical real estate. And real estate as an asset class has been in top 3 almost all this 21 year. I think it's 2 or 3 years they are not in the top. So real estate is a very good thing to have in the portfolio as a diversifier and to get good risk-adjusted return over time. Thank you. Now I went over time again. Sorry for that.
You certainly did, Mikael, but thank you so much for a very thorough market update. Now, before I leave you, I would like to ask, you did mention Evergrande, and it seems like a lot of investors under the equity market were taken by surprise by this, but apparently you weren't. What's your take on the Evergrande problem, if you like?
Good question, and actually I got it before, so I prepared this slide. The ones that have listened to me before and many times know that I've been warning for Chinese developers and real estate, and Evergrande has been the top pick there. This is a slow train crash actually that we that are sitting in the market has foreseen for a long time. There has been question marks about when and is this too big to fail because it's system critical. And we also know that the founder of this company is good friend with the president in China. So everybody has been thinking, no, but nothing will happen because of this. This is too system critical and he's too close friend to the party. But eventually the president of China and the party has to draw a line in the sand. And this is what has happened now, but they can't just leave it alone and let things have its time, because it's too much that depending on this. The last 20 years in China, real estate and real estate development has driven the growth in China. So, and it's very system critical. It's about 1/3 of the GDP numbers if you look at the real estate sector. So it has implication of banks, of course, all the producing companies, cement, etc., employment, and the last thing they want is to have a social unrest. So Evergrande has several thousands, tens of thousands employees, so they have to handle this carefully. And what they did to start to addressing this sector that they know very well, because they have been seeing what it has been done for the growth, and they have been afraid for this sector for a long term. That's why they have micromanaged it so thoroughly on actually city levels and also on people's levels, because they can say you can only buy an apartment in that town if you have a PhD education and you pay 30% upfront, etc. That's how they have. So they know the sector pretty well. Back to Evergrande. They implemented 1.5 years ago something they call 3 red lines. You can see that on the graph. And this was addressing the severe balance sheet of some of the largest developers in China. They hoped that this would help them to take down the debt and repay and make it more balanced. But what happened with Evergrande, they didn't, because it was already too late. So they actually said that Evergrande can't borrow any more money. It was banned from raising money. But Evergrande has been having a hybrid. They have bought football teams. They're building the largest football arena currently that will hold 100,000 people. They have bought into water bottling, banks, electric vehicles. They are all over the place, right? So what are we now? We are there. 1.5 million people are waiting for their apartments that they partly have paid to be finished. Obviously, Evergrande will not finish them. But what the state said is that other state-owned developers will take over this project to build them. Because the danger is in this situation is when people start to realize they can pay up front for an apartment that they will not get. So everybody will keep the money and not buying any apartments. And there are a lot of developers in China. So and price developments in China has already pre-Evergrande crisis has come down pretty much. So this will not be good for the banks, and this will not be good for the growth and hence the world economy, right? So what will happen with Evergrande, my take anyway, is that this will be a controlled implosion, meaning that they will tell, and they have already started to do that, the other developers that are state-owned to take over projects, to buy out assets, and also the banks to take collaterals, etc. in this, just to control the slimlining of this company. I think this is not something that will rock the boat, so it's falling over. It might be one component together with energy crisis that is rising now, together with other things. But Evergrande per se, I don't think that will be the big issue in China. It will have implications, and it depends also of how many of these 1.5 million apartments they can deliver to people to calm down them, and they will not see social unrest, more social unrest, I think, because that's the priority number one for the government. So implications to my portfolio, of course, I said it before, I have some Hong Kong listed companies, not so much assets in Hong Kong nor in mainland China, but they are listed in Hong Kong. We have seen a downturn there. I own CR Land. It's a small position, but CR Land is one of the few companies, if you remember, I told you about that actually were not in breach of the 3 red lines before it was implemented. So they can actually pay their dividends and interest rates with their cash flow, running cash flow, and that's a very, very big strength. So instead, they will come probably winning out of this situation, because they can buy cheaper assets and they can gain market share in terms of their size already. But there are reasons to be cautious here.
Thank you very much. Now, just the final questions I have for you is about Germany. Quite recently, some political activists have made the authorities buy into some German housing companies, and we know that Germany that you're actually overweight in Germany. What will the implications be for SKAGEN M2?
Another small question.
Now, let's try to keep it short, shall we?
I will. It started with this rental freeze that we have talked about before in Berlin. And the reason for the rental freeze was that the people living in Berlin thought the rents has come up very quickly. But seen in a larger context, it was quick, but from a very low level. So in absolute terms, it wasn't that bad. And at the same time that happened, there were some political activists claiming that they wanted to nationalize, or the government should nationalize the housing, the rental apartments. They also claimed that you should nationalize BMW or Mercedes and crazy things like that. But the big problem in Germany, as we have in Sweden and other places with regulated rental markets, there are higher demand than supply. So with a rental freeze and nationalization, there will be not one single unit more to solve the problem. So everyone in Berlin can actually claim something and have a vote about it, because it's the constitutional right to do that. And then you have some processes, and now last Sunday, when we have the big election, they also had election about nationalization or confiscation on rental apartments in Berlin at the same time. And this group had 56% of the votes, so pro confiscation. And the mayor of Berlin said we have to respect this, but we have to look at it at a constitutional law perspective. And a constitutional judge recently said it's unconstitutional against the national law, to have rental freezes that they had in Berlin. So this is a very complex issue, and I think to make the answer shorter, a confiscation has to, they have to buy out apartments. They have to buy it at market price, a fair price. And the city of Berlin doesn't have those type of money to do that, even if they wanted. We saw, as you also mentioned, Ole Christian, we saw 2 weeks ago, Vonovia sold about 20,000 units to the state of Berlin. This was a part of the deal when they merged with Deutsche Wohnen. But the only thing that can solve this now, because everyone is afraid that they want to send these political signals, depending on what coalition we will have in Germany, that there will be some sort of positives for these activists that are screaming the most, but it will not solve the problem. So eventually, I think everybody has to sit down and look pragmatic about this. And the only thing that can help the situation is that they build more apartments. Merkel had this 1.5 million apartments plan, but she did only 60% of that due to nobody could actually calculate that because prices were too high, processes were too slow, and a lot of environmental implications came in on top of the price, the costs that I had. So market has to help them to solve this problem. In this equation, you also have this future sustainability aspects that EU and Germany has set up. And a lot of that is hitting the residential players. So they will eventually come together and discuss how will we do this a sustainable thing. And they have to be subsidized and they have to give and take. And that's where I think it will end. The positive thing anyway was last Sunday, we didn't have the worst outcome for the residential landlords. It was the left green or the rot-green coalition. And that would have been really bad. So the market has been a bit relieved from this, but still there are some political uncertainties. But this is a very interesting area to be in, especially since they have been lagging, but they're still growing. Demand is super high, and out of a risk-reward perspective, I find it very interesting.